So the funds were launched in 2021. It was a time when sustainable investing was very popular after a decade of strong performance, supported by a low interest rate environment. At the time, the global economy was recovering from the pandemic, and governments were committing unprecedented sums to green infrastructure. As a result, some companies seen as sustainable champions were trading at a significant valuation premium to the rest of the market. We were coming out of the pandemic. We started to have a bit of an inflation problem, and this was really exacerbated by the Russia-Ukraine war. And that led to a huge increase in interest rates, which went almost from 0 to 5% in a really short space of time. And that created a real headwind for sustainable companies. They tend to be higher growth companies, and therefore we saw a bit of a valuation reset in that environment. Elsewhere in certain parts of the world, there's even been a bit of a backlash, actually, on some elements of ESG investing. And that's created an environment the last few years which has been positive for areas like oil and defence. And that's led to some questions as to whether those types of companies should be included in sustainable mandates. Now, we've not changed our criteria. We've maintained a clear rules-based sustainability framework that's resilient through the cycle. Our aim has always been to own businesses that can deliver attractive returns and contribute positively to the world. And that principle still holds today.
Our aim with these portfolios has always been to be as authentic as possible with our sustainability process and very clearly show clients what we will and won't invest in. And I'm really proud to say that this has paid off. Despite this rollercoaster macroeconomic backdrop we've seen over the past 5 years, we've still had net inflows into the portfolios. And one of our greatest achievements has been gaining the Sustainability Focus label under the SCA's Sustainability Disclosure Requirements, a regime which we achieved last summer. Now, what this does is it essentially gives our portfolios a big stamp of approval from the regulator, confirming that we have a robust and evidence-based standard of sustainability, and we predominantly invest in assets that are already either socially or environmentally sustainable. This was a ton of work for the team, but it's great because it gives our clients that extra bit of reassurance that we truly are walking the walk when it comes to sustainability, and they can trust that we're only investing in companies that are truly doing good for the world.
So the funds have a risk and return objective as well as a sustainable objective, and that makes us think about risk management a little bit differently. So sustainable funds can often carry inherent industry skews, and we've worked really hard in the funds to balance the portfolios from a style perspective, make sure we're not overly exposed just to growth stocks, and that was particularly important at launch when some of those companies were looking a little bit expensive. And that's mean we've ended up owning companies like John Deere, so maybe not seen as a traditional sustainable stock with their big tractors, but for those of you who've watched Clarkson's Farm, you'll know they're actually helping farmers navigate a very difficult world and to be more efficient, drive up crop yields, and drive down pesticide usage and fuel consumption. We've also looked at ways to try to shield the portfolio from things like energy price shocks, and that's including using things like currency, so like the Norwegian kroner, inflation-linked bonds, or a variety of structured products that we have in the toolkit.
I'm really excited about the renewed recognition and investment from both corporations and governments into the theme of renewable energy and electricity infrastructure. Now, over the last 5 years, we've had 2 wars, the war in Ukraine and the conflict between the US and Iran. And both of these have very much highlighted the urgent need for us to invest in energy security and reduce our reliance on oil imports. This, alongside AI's thirst for power, has meant that the conversation around renewable energy and electrification has really been brought back into the mainstream view. And this means even more success for companies that are aligned to this theme. I think everyone can now agree that a diversified energy mix is not only better for the planet, but also great because it means more control over where we get our power from. And this will shape into a pivotal discussion over the next 5 years, supporting so many companies that we hold in the portfolios, which is what we're really excited about. And we've seen this already with the likes of SSE, National Grid and E.ON, all of which are European utilities that we hold, already seeing great performance, particularly over the last 12 months, as they've increased their spending on grid infrastructure and also renewable power. And then over the other side of the pond, we've got US financer of renewable energy, Hannon Armstrong, which are also seeing great performance due to being a beneficiary of the energy transition.
I think sustainable investment is maturing. It's moved away from just broad promises and do no harm statements. Increasingly, the focus is on the sustainable investment process, providing more granular data, as well as increased engagement. At the same time, the future opportunity set looks really very attractive, and valuations now are much more sensible. Sustainable investment is increasingly tied to durable structural trends, so technology and artificial intelligence, electrification, infrastructure, as well as efficiency. So that's finding companies that can help societies adapt to tighter energy systems and higher resource pressure, whether that's related to water, to food, or to healthcare. Done properly, sustainable investment should help clients align capital with their values, while still giving them access to some of the most important growth themes of the next decade.